Okay, folks, welcome back. Real quick market review for our Wednesday. There will not be a teaching tonight, but there will be a teaching for this weekend, Saturday at 4 p.m. The weekly review will be posted. And I will be talking about how we can practice with our demo account, what we should be doing, what protocol, what step-by-step, because now you have done, hopefully, everyone has gone through their back testing and forward testing for the fair value gap. So I'm going to give you a procedure you can go forward with and help flesh out a little bit of the uncertainty about what it is you're supposed to be doing each day. Again, it's not to try to trade with live funds, it's to keep you focused on the engagement and practicing. But I'll have all that detail this Saturday. But nonetheless, we're looking at the dollar index as a daily chart. We had mentioned in last weekend's weekly review that we still had to open on this candle to concern ourselves with for dollar, and the open's at 96.36. So rounded to a 5 level or a 0 level. 0 level would be 40 and 5 level would be 96.35. And we had a nice reaction there. We traded back up into the bearish order block. I mentioned that the bulls need to see this high give way. If it does, then we'll be attacking the buy side liquidity pool here. Also, as I mentioned, we're still stuck in the middle of the range on this daily chart, 300 pip trading range. Here's a 50% level, still hovering around equilibrium. Real no displacement either direction so far. So again, it's just a day trader's market. I know you're probably tired of me saying that, but you know it is what it is. All right, so let's drop down into a 15-minute time frame. All right, so here's our 15-minute time frame for the dollar index. And you can see the price trades down to a low of, let's see what we get here. It's probably going to fight me. Well, I'll just use this candle here. It's going to be the same. 96.35 and a half. Okay, or basically 96.36 if you were looking at another data feed. So nonetheless, we had our bullish order block from the daily. This is what this shaded area is denoting. And then we had a nice market structure break here with this swing high being broken. Price comes back down, trades into a fair value gap. And I mentioned this by way of charts the other day. And then we had another fair value gap in here. And price expanded on the upside. Another fair value gap here. Consequent encroachment. Beautiful. Fair value gap in here. Price comes down, hits it as well. Fills it in. Another expansion. Then price trades up into that daily bearish order block in here at the 97 big figure. And then we've since encountered some resistance there. And again, I mentioned we need to get above that old high, which is a little bit higher than 97 relative to its daily chart. Now what I want to talk about is the moment it hit in here. So this turning point in here on the 15th of July, we had again a market structure shift here after an order block had been hit on the higher time frame. So if you're looking for like intermediate term price reactions, something that offers like 50 pips or so, that's kind of like my forte. That's what I frame my one shot one kill scenarios on. I want to have some kind of an intermediate term price swing. So if I can get that off of a daily chart relative to a bullish order block, a bearish order block, filling in a fair value gap, something of that nature, or if it runs an important high or low and my institutional order flow is counter that recent raid in price. In other words, say my institutional order flow analysis leads me to believe that the market is posed to go higher, or poised to go higher rather. If I see some low being taken out and I see that as a stop run on sell stops, I can accumulate those sell side liquidity orders and pair that up with a buy for myself, and then that would be utilized for intermediate term price reaction on the daily chart. I outlined this one for you all last weekend. I mentioned that this is a very specific price level. It was that opening price on the daily chart on that down candle for the dollar index. So that kind of like gives us the framework. So if we do get a structure break, we do here, and fair value gap, and we start seeing evidences of institutional order flow being bullish now for dollar, we're going to take that information and segue right into on the 16th for euro. So here's the 16th on the euro. I got the central bank dealers range denoted here as well. And again, if you don't understand what this is, it's talked about and taught in mentorship. So don't email me. Can you tell me how you did all that? It's all in the teachings. Okay. So we have all of the standard deviations for intraday volatility and a projection of 112.01 and 4 pipettes. The low on the day came in at, I believe it's just below that. The low came in at 112.01 and 3 pipettes. So it was off by 1 pipette. So it's not even a half a pip it was off. It was like 1/10 of a pip. Pretty precise. Nice distribution day here. We had a fair value gap in here. Price trades right above this candle's high. The high comes in at 12.32.1. And the next candle is it's going to give me a hard time. It always does. Let's see if I can get it to pop up. Oop, I gotta have to zoom in. And we can already see it here. The high, 12.32 and 1 pipette. So in other words, we're not expecting or relying on the gap to fill at all. All we need is the low end of the gap to trade to, and boom, there you go. We get another fair value gap in here. I don't have that noted, but you can see it does trade from this candle's high, trades into it here, and then that would be your fill for continuation down into the low of the day. I'm going to zoom back out a little bit because it's really too much. All right. So we have fair value gap there, another fair value gap as well. Price trading back and forth in here, consolidating, and then a final expansion to the downside, again running to the central bank dealers range low. Now what you're looking for is you're looking for true day. True day, in other words, a total daily range, okay, and what is available in time. So the limitation as to how many standard deviations you're going to have is going to be directly related to what PD arrays exist left in the marketplace, how much time of the day is still there. So these calculations are going to more or less update daily, or not daily, but intraday, because as one new level is taken out and we still have time, it's a lot of measuring going on, saying, okay, well, we get to this one, we have a little bit more time left, okay, I could go to this one, and it becomes a measure of experience. Okay, so if we can combine things like that also with runs on liquidity from the big figure stance or the 20 level, the 80 level, or 50 level, in other words, we're trading down into that 112 or approaching the 112 big figure. It may not get to 112. It may not sweep 112. They may defend 112. As you can see, we see that happen here on the 17th. I've calculated the central bank dealers range again here. And the standard deviation, first one takes us to 111.994. 111.994 is over here. And the actual low comes in, again, it's going to fight me, 11.992. So I was off by 2 pipettes there, not even a half a pip. And price is shown and willing, so I want to go higher. We have a market structure break here, taking out the initial high of the day. Price comes back down. We have a fair value gap there. You can be aggressive if you were wanting to use that as well. Price coming back down into a bullish order block. And price rallied higher, running into a projection of 112.32 and 4 pipettes. Now, why do I have that noted? If you look back over here, you see a fair value gap. So what standard deviation exists inside that fair value gap, or approaching it, or completing it? So it could be this one or this one. So low-hanging fruit objectives, again, this is the first one we get to, meeting very close to the low. So 112.32.4, and the high came in at 112.33 even. So off by 6 pipettes. So just 1 pipette above a half of a pip, creating the high of the day. Okay, now this is summer doldrums, folks. It gets way, way more precise when we get into the fall and winter months. But we have a fair value gap that's closed in here. So we'll see if it wants to expand higher, make an attempt to run up in here. The next levels of interest I like are, we have this standard deviation with this fair value gap right in here. And I'll just note that real quick. I don't want to spend too much time on this video today. Alright, so we have that, and then the next one is here. Okay, so on an upside, if we continuously see the dollar go lower, or if it just stays in a more pronounced trading range for tomorrow and into Friday, that would still permit the euro dollar to trade up into any of these fair value gaps. Okay, so this could potentially be some kind of a rounding out of the weekly range, and we'll see if we can get back up inside of here. If we measure the range for we have traded right to 50%, which is also a fair value gap, so that would be a minimum. So if this does not rally, we do have sell-side liquidity resting below these equal lows. I don't know about that personally. I think we're probably going to see more of a consolidation the rest of the week on euro dollar, hanging in the range here and here. If we do trade higher, I don't expect us to take the buy side liquidity pool resting above these equal highs just this week. It may require next week to do that. That's assuming and making assumptions based on what I see in price right now. Obviously, this could change and morph into something entirely different if there's more data provided. But right now, given what's being shown, I think that's a fair assessment for right now. The SMT, correlated S&P divergence in here, you can see during the Asian session or Asian range, central bank dealers range, and here's the Asian range in here between here and here. We have a slightly higher high on euro. If we move on into the cable market, you can see we have a lower high. There's our correlated SMT divergence, or correlated pair SMT divergence, heavy distribution in cable. So you can see while they both had respectable declines, the cable market was a little bit more obvious in terms of seeing the distribution because of the SMT divergence there. What's being denoted here is the flout, and I have two levels here denoted. The 2396 level, projected daily low, and the low came in at 23956, so off by 4 pips. It went just a little bit below it. And then I have this only because of where we had today's projected low was 123.85 and 2 pips, and then from Tuesday's standard deviations we had 23.82 and 2 pips. So it's important to start looking for confluences of levels within 5 pips. Okay, so everything's always within a measure of 5 pips. I believe that 5 pips is a reasonable deviation across all platforms when we're doing these types of calculations. You're never going to have it line up perfectly. So if you start using this with a live data feed, your brokerage firm is going to have slightly skewed data. You're just going to have to deal with it. Okay, there's no way around it. Okay, but as a general rule of thumb, our calculations should be within 5 pips, and I think that's a reasonable expectation, given that 5 pips is extremely tight in terms of range. It doesn't mean use 5 pip stop losses. It just means that we would reasonably expect some confluence of reaching for liquidity or reacting off of specific levels around a measure of 5 pips. And what do I mean by that? We have 123.82 as a low, and then on the 17th today, I had a central bank dealers range calculation of 123.85 and 2 pips. So you can see we're between 82 and 85. We're only talking about 3 pips. So again, there's only 3 pips variance between these two specific calculations. Price trades down today, creating a very low of 23.81.5. Okay, so 81.5 pipette. Or 5 pipettes rather. So 23.82 would be most likely what everyone else would see on their other data feeds that don't use pipettes. There's 23.82 and 2 pipettes. So again, a lot of confluence there. And then what I'm showing here is the previous day's low, 123.96 was the projected low here. If we use that and go 15 pips below, okay, 15 pips from 96 gives us what? 23.81. And that's what 23.81 is denoting here. And again, we were only off by 5 pipettes or half a pip, creating that swing, more or less creating the low of the day. Price expands up, trades up into a bearish order block. This is a PD array or a premium array. And you can see there's two levels here that would actually be used or could be used for that. I'm only using the highest one because it's very pleasing to see that, to show the measure of precision there. But there would have been nothing wrong with using the initial run to this low on the order block. If I can get, I'm not going to mess with it because it's going to drive me nuts because the rectangle's there. But you could use that as your target, okay, going along on anything in here, trading off of a bullish order block in here, expanding up, and standard deviations on the outside. So we had one standard deviation to 123.85, and then a bearish order block in here, which also could have pumped up into the fair value gap existing between here, and that would have been that level there. So how do you use these levels? I do talk about it a lot in the later months when we start talking about day trading content. So if you haven't got to that month, it's there. Also, it's in price action model number 5, I believe. I give a lot more detail there. So don't think that you need to have all this understood in this presentation. I'm just providing some content today to get you thinking a little bit, and also to stimulate some of the charter members. So either one of these levels, here, here, or here, would have been acceptable for upside objectives. So what you could have done is taking something out at the low one, the low of the bearish order block, the bulk of it, I should say, and then use that level as another level you could scale out, and then take another portion off if we get up into the fair value gap on this level. Okay, and then obviously if it keeps on going, you would have something to take some buy side liquidity out over here, because that would be the next upside objective. Should this turn around, say it turns, this would be the buy side liquidity pool, because it's too clean. Even though we had SMT divergence in here, I think that would be a level of watching, and I'll be watching that Thursday and Friday going forward. And folks, that's going to be it for today. Like I said, I will have the weekly review Saturday about 4 p.m. my time, and then I'll include a lesson, a price action lesson on that video as well. And I think it's going to be it. So until I talk to you next time, I wish you good luck and good trading.